Welcome to the STR Data Lab.
Hello, and welcome to another edition of the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined here again with my favorite long-running guest, Dr. Bram Gallagher, to talk about February short-term rental performance. Bram, welcome to the show.
Thanks for having me, Jamie. Always a pleasure.
So, Bram, it's been what maybe we could say is a wild ride to the start of the year. I seem to remember your January headline was a cooling of short-term rental performance, and February was a thawing of short-term rental performance. So really throwing in the weather comparisons here. So maybe just give us give us a breakdown of what we saw this past 2 months and what sort of led to some of that volatility.
Yeah, and weather had a lot to do with it, actually. So as you recall, January was a very difficult month coming after a difficult year in 2023. There was a terrible cold snap across much of the northern United States. Occupancy had been following the 2019 levels, essentially. But in January, it dipped to one of the lowest occupancies that we've ever seen. So it was a cold January, except there was no snow. So very low snowpack in California and in Colorado. So that's usually one respite from cold weather, is at least you get out there and ski. But it was difficult this time around. February, we saw a big bounce back, though. So I'm really glad to see that, because I was really hoping that we wouldn't see 2 data points in a row, because you can create a trend out of 2 data points.
Is that the rule? 2 data points make a trend, and one is potentially just an anomaly.
That's 1 data point is not a trend to make, but if you got 2, you can draw a line between the 2, and you can get a trend for sure. But luckily, we didn't see that. In fact, we saw some very, very strong numbers. And I should caution a little bit, because we had an extra day in February. So when we compared demand year over year, there's about 2-3% already there. And it didn't appear so at the time, but February of 23 was kind of an anomalous weak demand month. But still, this is very good numbers, 15.6% demand night growth in February. And that's up from 1.2% in January. So that is really something to smile about. Occupancy was well below what it was in the year prior in January. Now it is a percentage point above. So it looks like we are coming out of a January that it was kind of a miniature pent-up demand, I guess. Nobody was going out in January. It was too cold. It was a terrible flu season that we had 5 weeks later than we had the previous year. I don't know about you, Jamie, but all my family had the sniffles in January. So, I think people are ready to try to get out a little bit. It's still the off season. So I should also point that out. That we see big demand increases, but this is off-season demand. But still, people were ready and willing to come out wherever it was possible.
Yeah, and I think that's an excellent point of sort of low season. And it is, I think February is the low point of demand for the year. So not a whole lot of people traveling. So small changes in the data can relate back to big changes and then the year-over-year changes that we report. So, and I like to look at the data on maybe a 3-month moving average and sort of smooth out some of the changes that we see. And when we look at that, and I think it sort of follows some of the longer-term trends that we've been seeing of, and on a 3-month moving average, we're seeing about 7% increase in demand. Still a slight decline in ADR of about 1%, and still seeing falling RevPARs of about 5%. Does that seem right to you?
Yeah. So we're coming out of, so for 2023, we had about 6.6 lower RevPAR. And I think we're coming out of a slowdown, I guess, a correction, maybe even you might call it, in 2023. So we're starting to pick up occupancy, pick up demand just a little bit. Supply is cooling just a little bit. ADR, we don't have the pricing power just yet, but that might come in later in the year as sort of the demand and supply get closer to one another in growth terms. So that sounds about right. And 3 months is a pretty good lag length because, well, to use the recent months as an example, we had an anomalously low January, anomalously high February, and then we've got December as the tiebreaker. And what do we end up with? It's a pretty good trend.
Yeah. So as those on video and even some on audio might be able to recognize, I am not in my normal spot where I record. For those on video, you might see a hotel behind me. I am sitting at the Atlanta Marriott Marquis at the Hunter Hotel Investment Conference today, presenting along with some other economists and statisticians in the space. And I wanted to get your reaction, Bram, to some of the trends that the hotel industry presented today, because as you know, we're all in the lodging space and accommodating travelers. And there's definitely some talk of some industry weakness. So January and February were both reported with declining demands on a year-over-year basis, down 1.2% in both January and February. When we look at RevPARs for hotels, they were down in both January and February, down 1.1% in February, down 2.2% in January, after declining 3% in December. And I thought what was also really interesting is when you sort of break out that demand change, the weakest part of the industry is on the economy and mid-scale segments, where over the past year, economy demand is down 5.5%, mid-scale demand is down 2.5%, and really where the strength is with demand growing 4.5%, 5% on the luxury and upscale side. And a lot of the talk here is about the return of business travel, return of group travel, and people are going to meetings, they're going to conventions, conferences like these that I'm at right now, and where the weakness is on the sort of lower end consumer traveler, a piece of that being because maybe pent up savings during the pandemic have been exhausted. There's increased delinquencies of credit card debt. There's really maybe part of the consumer that's feeling some pain right now. And I wanted to get your reaction to that, and then also see what you've been seeing in the short-term rental data that maybe supports or counteracts that narrative.
Sure, yeah, and for the people just listening in, I do want to confirm that Jamie Lane is wearing a tie today. So it's an important conference.
I mean, that's the difference between a hotel conference and a short-term rental conference or vacation rental conference is hotel conferences, you got to
Is
wear your
the
tie. I feel like vacation rental conferences, if I wore a tie, I would look a little bit out of place and typically don't even wear a suit.
Yeah, exactly right. And you know what? I think that does speak to the division of the clientele to some extent. To broadly caricature, and this isn't, of course, always true, but broadly caricature the two markets. Hotel does have more of a business focus, and we see very very dominant leisure in short-term rentals. So one part of that might be, well, for February, I've noticed looking at just the chain scales, we see a little bit more strength in the lower end as far as occupancy and in pricing power. So, one of the things might be is that lower end consumer in the hotel space, maybe switching over to short term rentals for a variety of reasons, maybe for longer term stays, maybe for larger accommodations to have you can bring the whole family along, something like that. So we haven't seen a sort of anomalously low performance from the lower end chain scales for short-term rentals. So maybe there's additional substitution. And that's something that we've been talking about is in the short-term rental industry. A lot of the growth that we've been seeing is sort of assuming more share of the total lodging market. We're still going to see that in 2014, but the rate at which short-term rentals are taking share is definitely slowed from some of the early days. So it's going to align more closely with, I think, hotels in the future as far as the growth.
And that actually aligns with some of what I've been hearing here of asking that question to other analysts, sort of looking at the data. and they've sort of noted that short-term rentals among the guests that they survey is still seen as the affordable option relative to hotels. And where we've been seeing the strongest growth is in the 3, 4, 5 plus bedroom units. So as maybe consumers pull back, like maybe they were staying at a resort all-inclusive hotel. Maybe they were and going to the beach and spending 4 or 5 days renting multiple rooms at a property, and are now choosing to maybe save a little bit of money by renting out the entire house with multiple bedrooms and housing the family there, maybe doing meals at home instead of going out, things like that.
Yeah, so it's great for families. And I actually had a reporter asking after spring break pacing and saying that he was actually going with a group of friends to have his spring fling. So, not just families, but even now groups of adults that are friends might get a cabin together in the mountains or a beach house and be able to split the cost for affordability reasons.
So that reminds me of a question I wanted to ask you on how spring break is shaping up. I was reading in the New York Times I think it was last weekend, that Miami was canceling spring break, telling people to go away. We've seen sort of a volatile, as we talked about, January and February. So how's spring break shaping up? Is demand there? Or are guests coming, or is it going to be more weakness as we look forward?
Yeah, the pacing data looks pretty good, but there is a shift because Easter now is falling in March rather than in April, so it's quite a bit earlier. A lot of spring break calendars have changed as well. So what we're seeing here is that the hottest growth week is that final week in March, and we're actually seeing demand dip for the second week in April. So yeah, but we are seeing some pretty good pacing. So 35-40% year over year growth for that week as far as demand pacing goes. And something that I thought is interesting. So you're right. So Miami is saying don't bring on the spring break, and they are not pacing as strongly as some of the coastal areas that we're seeing. It's true what the Beastie Boys said: you have to fight for your right to party. Yes. But what I have been seeing is there's a lot of interest in sort of Atlantic coastal destinations: Myrtle Beach, Wilmington, Outer Banks, North Carolina, Norfolk Beach, Virginia Beach, all the Maryland beaches. These are all pacing very, very strong. So we're seeing for that last week in March, between 76% higher demand for these markets. So that's kind of an interesting twist. We are seeing, there are some places too in Florida, Santa Rosa, Rosemary Beach, on the Gulf, in Panama City. They're pacing pretty well, 55% higher for Rosemary, 45% higher for Panama City. The big winner is the Puerto Rico area. So not San Juan, which is also pacing pretty strongly at 50% higher, but for the Puerto Rico area market. And this includes all sort of the smaller destinations around Puerto Rico. It's kind of an aggregate market that we have for outside of the big cities on the coastal areas, 112% higher pacing for the last week of March. So that's great to see. A lot of people trying to get out.
And you had mentioned Easter. Do you attribute a lot of that to the Easter shift of where it had been in April last year, now in March, and just maybe pulling forward some of that demand that would have been happening in the different week prior year?
Yeah, that is a big chunk of it. The Atlantic coast is still a bit chilly in March, but yeah, so that I think is a big part of it, because we are going to see a little bit of a dip in April. But on balance, I think we're going to see pretty good demand growth overall compared year over year if we take into account both of those months together.
Okay. And then February, as most people know, is a big time for the ski resorts. It's maybe where last full month of ski season. So do you have any data on how the major ski markets sort of ended up for the month? I know you had mentioned maybe it was a weak snowpack that we'd been seeing. So did that show in the numbers?
It certainly did in January, but we're seeing a little bit of a bounce back in February. So January is the top month for a lot of these places, but February you can do a little bit of cleanup. So we're seeing Big Bear, California. So California had almost no snow in January. They've gotten a little bit back, so they're up about 16% year over year for February, and their occupancy also is looking pretty good, about 5% higher than it was. So we're at 46.9. Again, it's not the highest month of the year, but that's good performance for February certainly. Some other standouts, we're seeing some more in Salt Lake City, so Utah as well, and also Telluride, 14% up in Colorado. Colorado's had some difficulties with their snow as well, so both of those places are looking okay. Some of the laggards, I guess, Lake Tahoe still about 4% down from where it was last year, and February is usually a pretty strong month for Lake Tahoe, so it's a bit of a miss.
And when you're talking about these percent changes, are you referring to demand change relative to last year or ADR or RevPAR? What metric are you referencing?
Oh, I'm sorry. I'm looking at both demand and occupancy right
Okay.
now.
So that sort of speaks to some of what we're seeing across the country. I know the other metrics I love to sort of tap into with you while we're talking is just what's going on in the overall economy.
Mm,
We've got our favorite variables, looking at incomes, employment levels, unemployment rates, consumer price indices. And I know a lot of the headline figures were high, and maybe high is a good thing for employment, maybe high is a bad thing for CPI, and broadly, what did you see over this past month in terms of the overall economy, and how does it make you feel in terms of setting us up for the rest of the year?
well, that's a great question. It is, of course, it is of intense interest right now. We're trying to figure out when the Federal Reserve is going to cut the rates. They've been holding rates at pretty high levels after they increased them at the quickest pace that they ever have. And I think Jeremy Powell is going to be looking for cracks in the economy. So you've said that at the hotel investment conference, the hotels are starting to see some broad weakness. So, again, that sort of speaks to me for the business traveler and also for that lower end consumer who is looking for additional value by maybe trying to rent in the short term rental industry. So that's a little bit worrisome because this last month we saw sort of conflicting signals. CPI inflation, it went up just a little bit, 3.13 to 3.2. And we know that the Federal Reserve has been keeping those rates high to try to get that inflation rate down. Now, if we look at core CPI, we strip out food and energy, it was exactly the same in February as it was in January. So it's not as alarming. But on the other hand, it didn't decrease. The PCE, which the Federal Reserve, that's their favorite measure, stayed about the same as well. So I think that they're going to be holding the rates a little bit longer. On the other hand, there are a little bit of cracks showing in the broader economy because unemployment went up 3.7 to 3.9. So it was a good jobs report, but this is a higher unemployment level than we've seen over the last year, and that has been really the strength. That's really been the justification for being able to hold rates really high for very long periods of time is that you've got this incredibly powerful labor market. If we start to see that slide, we might miss the soft landing and then crash the plane and end up in slowdown territory, which we're definitely trying to avoid. And a very very difficult part of this, of course, is that the transfer mechanism of interest rates to the rest of the economy is on something of a lag. So even if we were to cut rates tomorrow, we might not see that reflected in the broader economy for a little while. So there's some forecasting that needs to be done. Interestingly enough, Wall Street had been initially expecting, say, 6 rate cuts at the beginning of the year. Now they're scaling that back to 4. And this whole time, I think Jeremy Powell's been hinting at 3. And it's been my belief this whole time along that take him at his word. It's going to be 3 cuts this year. So a little bit more economic difficulty before we get to the light at the end of the tunnel, but it should be coming by the middle of the year, I'm thinking.
Okay, so this is going to be a fun prediction for you because we're recording on Wednesday in the morning. The Fed's going to make an announcement this afternoon. And by the time this comes out, we're already going to know what the Fed is going to do. So it's a true real-time prediction where you think the Fed's going to hold today. I agree. Maybe we're looking into May, June for the first rate cut. Is that what you're thinking?
Yeah, and I'm leaning more on June. I think that, yeah, the Fed's going to come out today and they're going to present conflicting data and they're going to have mysterious signals, but will hold rates. Leave the possibility open for rate cuts in May, but it's going to be my eventual, or my eventually I think it's going to be a little bit later in June.
All right. Well, Bram, this has been an enlightening discussion. Is there anything else you want to mention before we wrap up?
Well, of course, all the buzz is about the eclipse, but unfortunately, I think by the time that this goes out, if you wanted to get a room for the eclipse, it's too late.
So
So,
Bram, I've been hearing that the eclipse is and the sun is the new Taylor Swift. Is that true?
that would be implying that Taylor Swift was the old sun, which, yeah, okay, I can guess. I can get behind that. It is a phenomenal event. Now, it is short-lived. It's not it's not a tour that like Taylor Swift did that's going to be occurring over a long period of time, but it is happening simultaneously. And that weekend is going to be nuts for a lot of places. I have been following this, and there's just so many cities now: Dallas, San Antonio, Austin. You go up to Buffalo. Buffalo is full. Buffalo was full weeks ago for the eclipse. Vermont, a bunch of places are out across Maine. It is just, Missouri, Kentucky. There are just so many stories now that, again, I think if you're listening to this podcast, it's probably too late to book a room in some of these cities that are in the path of totality.
So you are on full on eclipse watch until April 8th. What do you think we're going to learn from it once we get past it? And we need to sign up the sun for an eclipse, or the moon for an eclipse every year?
Yeah, I think it took a lot of people by surprise. We haven't seen the ADRs go up as much as I would have expected for the incredible occupancies. And I think the parts of that were that these star watchers book real early and they book fast. So they caught a lot of these operators by surprise, because everywhere I look, the occupancies are sky high, but the rates are, at best 40% higher, but in some cases only 10, 15% higher than they were last year, which is incredible for early April.
Well, Bram, I think that positivity is a great note to end on. Hope you're doing well. Have a great week, everyone. Thanks for tuning in, as always.
Well, thank you, Jamie. Enjoy the conference, and you'll have to tell me all about it when you get back.
Awesome. Thanks, Bram.